We actually did a video with Rob last year. That was really great. We really appreciated his insights. And so we wanted to do a follow-up this year to see what happened in the economy. Was his views and positioning correct? Kind of like a brief summary of what happened. So last year you talked about higher for longer interest rates, stickier than expected inflation, or compared to what a lot of economists were telling us. How have your views changed over the past year, or have they changed? Are you still in the same kind of higher for longer, structurally higher inflation camp?
Yeah, I mean, I think that, the higher inflation, the higher rates are structural. So I don't think that these are things that are going away at any time. Now, things are going to ebb and flow. There's shorter term cycles around the secular trends that we're going to see. Obviously, if we go into a recession, I'd imagine you're going to see disinflation and rates coming down. But as long as the economy is growing and doing okay, that you'll continue to see these pressures on rates being higher and structurally higher inflation. So I don't think things are going away with respect to that. The one thing I guess that we've talked to clients about is that while the market I think is recognized now that rates are moving higher, inflation is going to be stickier to the upside. Asset prices really haven't corrected yet. So there's lots of things in the market that are still expensive. So I think it's going to be important to remain a stock picker and find those areas of the market that are undervalued.
Right. So it's a perfect segue into our next question. You mentioned the market being expensive, and a lot of people say that why do we invest in the stock market in this kind of situation? Or even when you can clip over 5% in a high interest savings account, why would you invest in?
Right. So I think there's to unpack that, there's the broader market, and we've always said, we think this is going to be a really difficult decade for the broader market because the broader market is expensive. And when you look at how the broader market is made up, it's very concentrated in a small group of expensive growth stocks. And a lot of those are in the technology sector. So from a broader market perspective, I think it's tough. But there's lots of stocks within the market, 490 stocks kind of in the S&P 500 that are much cheaper than those top 10 stocks where there's lots of opportunity longer term. And yes, bonds look more attractive now than certainly they did before. Rates have moved higher, and for an investment grade, high quality bond, you're getting a very nice yield at the moment. And I think it's important to have some of that in your portfolio from an income perspective. The issue, I guess, what you have longer term with bonds, if you're in this period of structurally higher rates and inflation, you got to look at things on more of a real basis than a nominal basis. When inflation was very low, the past decade, most of the last 40 years, you could look at things on a nominal basis. But now that inflation's higher, you got to look at things on a real basis. So you might feel good if you got 5% on your cash, or slightly higher, let's say on a bond, but you have to adjust for inflation as well. And what a stock provides you is that inflation protection. There, you're going to see your nominal earnings grow, and as long as the valuations aren't contracting in the stocks, I still think that stocks are going to be the better longer term investment, even from these levels of where rates are.
Great. And you did mention too previously about recession. So that's something that we get asked a lot right now is there a recession coming? People are concerned about people renewing mortgages over the next couple of years. We see a lot of headlines about negatively amortized loans at banks or really high mortgage payments. Also, corporations during the COVID crisis termed out their debt or refinanced a lot of their debt. So even though rates have gone higher, it hasn't really hit their balance sheets or their profit margins. What do you see for maybe recession and people who are worried about banks going forward?
Yeah, I mean, I think there's clearly lots of issues in Canada with respect to the consumer and just the structure of our debt. It's more variable. Many people locked into rates, let's say, around COVID. We saw a boom in real estate and people locked into mortgages. Now we're going to roll over to higher rates in the coming years, and that's going to put pressure on the Canadian consumer. If you look at the U.S. consumer, many of those consumers in during the COVID recession went and refinanced and locked into 30-year long mortgages. So they're locked into a low rate for a long period of time. So there's more resiliency, I'd say, in the US consumer, maybe relative to the Canadian consumer. Longer term, I mean, the curve's inverted right now. The curve is a precursor to recession. There's obviously a significant lag that you've seen historically between an inversion and curve and when you actually see recession. The issue, I guess, with a recession right now is that for a recession to occur, you need to see weakness in the labor markets. And the labor markets are quite tight. And there's more job opportunities than there are people to fill those positions at the moment. So, I think that there's obviously a risk the longer rates stay high and the longer we go, eventually you're going to run into, issues. But I think, a recession, even if we have one, is more likely on the mild side. So, and as we look at stocks in the stock market, there's many stocks that are already pricing in a recession. So just because there's a recession, let's say, coming, if it's mild recession, that might be priced into certain stocks. So I wouldn't necessarily conclude, even if we go into some sort of mild recession, that it's necessarily going to be bad for the whole market. This is not like a 2008. This is not a COVID sort of scenario where the whole economy is shut down. If you look back historically to other recessions, there's lots of examples of mild recessions where you can still do well if you stock pick and find the right areas to be in.
Right. And you touched on the US and Canadian consumer. Do you consider them healthy right now? Are they doing okay?
Yeah, I think if you look, let's say, at the U.S. consumer, their balance sheet is in much better shape. There's not the same imbalances that existed going into, let's say, the great financial crisis in 2008. There was a lot of repair during the prior decade. That was a debt deleveraging cycle, and consumers got themselves in a much better position heading into this decade that we're going into now. So I think that the consumer is in better shape. The consumer's been more resilient than many people thought. But, the longer this goes on, at some point rates are going to have an impact and you're going to start to see a slowdown. I think there's already some examples of slowing in certain parts of the economy. But this is not like the dire great financial crisis type of scenario that people, I think, should be preparing for.
Obviously, the hot topic of the last couple of years has been inflation and interest rates. So we already touched on kind of what you think of inflation, but do you think central banks are done hiking interest rates?
I think we're getting pretty close to the limits right now in terms of how high rates can go without causing, significant impact to the growth of the economy. Now, we've always been of the view that rates are in a trend higher, but they're not going to go straight higher. So I think, maybe we've hit a level where we've got to go through a period of digestion where rates kind of stay stickier where they are today and remain at, current levels for a period of time. Not saying that there's not going to be some volatility in rates if we go into a slowdown, if there's any sort of geopolitical skirmishes, et cetera. You'll see, I think, rates coming in and be more of a defensive asset class. But I think, 4 to 5% seems about reasonable for where rates will be for some period of time.
So do you think about the geopolitical state of the world? Obviously, there's a lot of wars and things like that going on right now. We're filming this on October the 12th. So what do you think kind of the future holds, and will it impact markets?
Yeah, I think that when you look at the world and what's going on, the last 30, 40 years, we were in a period of globalization and cooperation. And I think we're structurally moving and secularly moving away from that into a lack of cooperation, barriers going up between countries, more geopolitical conflict. And, there's a huge divide in the world. We're going through a period of populism, large divide between the haves and the have-nots. So, we've seen this through history, and it generally ends with a lot of geopolitical unrest. So I would be, more in the camp that we're going to continue to see these sorts of skirmishes around the world. And that's why, having like an asset class like energy, for example, is going to be important. And it's actually more like a defensive asset class in these periods of higher geopolitical unrest.
Okay. And that's a good segue into my next question, which is, how is the fund positioned now? You can maybe talk about this year, how you've been positioned. Are you making any changes going forward, or kind of how are you positioning things right now?
Yeah, so and we were talking about this a little bit at the beginning, that on a year-to-date basis has been an environment that's really been driven by 7 or 8 stocks. I think 7 stocks in the S&P 500 are up 50% on a year-to-date basis. The remaining 493 stocks are only up 7%. But those 7 stocks are disproportionately impacting the overall return of the broader market. So I guess it makes some sense to us. Inflation peaked in the summer of 2022, and we've been in this disinflationary wave. And on top of that, not a lot of people were positioned those stocks. And so we had a balance of money on a year-to-date basis, but they're quite expensive again. And the market is even more concentrated than it was even a couple of years ago in terms of those top 10 stocks. So we do have some concerns going forward. Like if you had $1 to deploy today, are you better putting it in those stocks or in the remaining 493 stocks in the market that are cheaper and have relatively underperformed? And we're still firmly in that camp that we're in a stock picking environment, and there's lots of individual opportunities that we're seeing right now in the market that are cheap, that might be in a recession, that we think we're very confident when we look out over the next couple of years that we can generate a very strong CAGR in performance for the fund in the stocks that we're invested in right now. So there's lots of opportunities that are popping up right now, I'd say, that we're excited about over the next couple of years.
Oh, that's perfect. And just for people who are watching this that don't know, CAGR is compound annual growth rate. So it's a really high annual compound on the growth of these companies. What keeps you up at night right now?
Yeah, I mean, we're more value investors. So if you think about the last decade, it was a growth-driven environment. It was an environment where central banks were printing money, fighting deflation. So if we fell back in that kind of an environment, that would be difficult for what we do in terms of how we're positioning our portfolios. Obviously, we don't believe that. We think it's going to be like this decade is the exact opposite of the last decade. So many of the things that were leadership in the prior decade aren't going to be leaders in this decade. So that's one thing. And then, I think the other things would just be like the geopolitical. It's like the fear. It's the fear of the unknown that there's. We could wake up tomorrow and, oil prices could spike to, over $100 or $120 because something happens in the world. And I think that'd be very destabilizing for the global economy and, wouldn't be good for many things. I don't think it's good for bonds. It's not good for equities. So I think our portfolio is positioned in a way that we should be able to do relatively well, even in that kind of an environment. But, that could be an environment that'd be challenging for almost any type of security.
Okay. So in the last couple of months, we've seen U.S. debt increase somewhat dramatically. Are you concerned at all about U.S. money printing, inflation, countries running structural deficits, even though we're kind of in an expansionary phase?
Yeah, I think it is a longer term concern that the debt that was taken on following COVID, the money printing that occurred. You have to pay the piper at some point in time. And I think the situation that the U.S. is facing over the next several years is that all that debt is going to roll over to a higher rate. So the interest burden's increasing at the same time they're running significant deficits and going into one of the biggest infrastructure spends that we've seen in our lifetime. So
with the Inflation Reduction Act and CHIPS Act, onshoring of
onshoring, yeah. There's lots of investment going on in the U.S. right now. So it's gonna be a challenge in terms of how they're gonna balance the books. And I think we've seen this in the past. After the Second World War, there was a lot of money printing. There was a lot of debt taken on. We went through these periods of inflation, and ultimately what happened is the Fed had to come and do yield control and fix rates. Right. And I do worry, and I think a lot of people that I would listen to would worry in the future that that's a scenario that might be realistic, which, if that were to occur, and because the interest burden is increasing so much and the Fed or the government won't be able to afford all these costs, and if they had to do yield curve control, that means you're accepting a higher level of inflation. So it would contribute to the inflation problem that already exists. So not like the best scenario, but again, when you're thinking about how you want to position your portfolios, it is a very different leadership, a very different portfolio than what did well over the past decade. So, and I think we're positioned to do well in that sort of environment.
And you've said it a few times how leadership over the next decade is probably going to be different than what happened over the last decade. And historically, that has significance as well, because generally we do see that happening. Like usually leadership passes the baton, I guess, so to speak, to another sector of the economy. Do you have any idea maybe where you think that sector is, or?
Yeah, I mean, so it's interesting. If you look, I've got an interesting chart, and we could share it with you just in terms of the concentration of the top 10 stocks in the market. And we're about 32, 33% right now. It got to 28% in 2000. It got to 34% back in the 1970s with the Nifty 50. So those are after passive-led environments, and everyone concentrates in the same stock. And then over the next decade, as you unwind those former leaders and new leadership unfolds, you go into these sideways rotating markets. So I think that's kind of what we're going into. So it might be a challenging time for the broader market, but if you can figure out these areas to rotate into, you could do quite well. And I think some of those areas are going to be, maybe industrials, for example, are a new secular grower. I think energy, just this is a decade of supply issues. I mean, we've underinvested in supply and things like resources, so energy or materials could do quite well. If we're going into significant spend and with higher rates, I think that's going to probably be okay for things like the financials, which are a big value area of the market. So I think there's going to be opportunities. They're more kind of cyclical value, I'd say right now. That's where the cheaper areas of the market are. And I think the things that are more exposed that you want to avoid are the really high multiple expensive stocks. And I said at the beginning, what's happened in the market is the market, I think, has accepted higher rates, and higher inflation are likely here to stay. But what hasn't really corrected is asset prices. And some of the former leaders of the past decade still have expensive valuations that could unwind. And that's what happened with the Nifty 50 in the 1970s, that their multiples contracted by almost 70% in that decade between 1970 and 1980.
Yeah, and some of them don't exist anymore. So.
Yeah, I mean, that's the reality. When you look back on this time, we'll only know in hindsight, but I'm sure things are going to change. Kodak, right? Yeah. Kodak, Polaroid, I mean, some of them still exist, but a lot of them disappeared. Yeah. So that's the thing about technology is it's shorter cycle. There's innovation constantly. Yeah. There's new competitors that show up.
Are you concerned about AI at all? Or?
I mean, I think AI is... I don't really know. I don't think anybody really knows. I think it's obviously something that's going to increase productivity, and there's probably a lot of good things with respect to AI. Where we are in terms of monetizing AI, I think the one clear leader has been NVIDIA. They're the ones that's building the infrastructure for AI. It's kind of similar to like Cisco back in 2000, where you were building the infrastructure for the internet. But I don't think it's very clear at the moment how companies are going to monetize and make money on AI. I think that remains to be seen.
Okay, great. Well, thank you very much, Rob. We really appreciate you doing with us. And hope you have a great day.
Okay, thank you.
Thanks.